There are two main sources of inflation. There's the usual supply and demand for goods, cyclical inflation, so that when there's a demand for something, that there can't be a greater amount of supply being produced for it. There's an upward pressure in that price, and so that comes from strong demand pressing up against capacity limitations. That's cyclical inflation, and it depends on how far the central bank accommodates that. So that's the cyclical inflation. The second is monetary inflation. When the production of debt is large, but the central bank produces more money and credit, that has the effect of devaluing the value of money and credit, which doesn't show up really as it doesn't look like it is going down as much as it looks like other things are going up, so that you see things going up as they are now, and that's monetary inflation. I think right now we have both cyclical inflation and monetary inflation, so that if you look at the demand for everything, right now the demand is greater than the capacity. It's really a excess demand issue, but provided by a lot of money and credit being put out. And we also are running large deficits, and as we start to look farther forward, we have these very cheap interest rates, which means that it pays to buy things like, let's say, houses. I mean, practically, there's no interest rate to speak of. And now a lot of loans are made on interest-only loans even. So with hardly any interest rate and not having to pay back principal payments in terms of the amount of ridiculousness that it's gotten to that way, there's a lot of demand for those kinds of things. Now, that could be cyclical, but I don't believe when I look forward that our deficits or the net will be primarily cyclical. So I looked into the issues of politics and the issues of the deficits and the needs for money and credit, or the desires for money and credit, and I think that they'll be structural. And I think then also there are certain changes in expenses. For example, while I believe that climate change and moving to cleaner energy and other such moves is very good for our ecosystem in the long run, it's also very expensive and it makes less efficiency. So that's going to, at that same time, add to inflation. So yeah, my worry or belief is that that will increasingly be built into the process, which we're seeing, for example, in terms of changes in compensation, changes in many, many things. Everybody's seeing inflation around them, and it's not just something that's going to settle back. So if I take the cyclical piece, it's going to require enough of a tightening, if you were to deal with that, enough of a tightening in monetary policy to stop that buying. The consequences of that would be very bearish for markets, and it would be very bearish for the economy, and I believe too bearish for the Federal Reserve to want to tolerate. And that would only deal with the cyclical inflation pressures, whereas at the same time, we have the structural issues of those kinds of deficits that need to be monetized. So for those reasons, I don't believe it's transitory, that we will go back to what we experienced before.
In August 1971, the U.S. President Richard Nixon did this.
Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
With the removing of the gold standard, the creation of money that we know today had started. The printing press was put on work, and the amount of US dollars in circulation had skyrocketed. In this picture you can see the rise of the money in circulation from 1970, and then the spike that we have now from 2020. The money can be created almost without any limit. The new monetary policy made the 1970s the most inflationary decade in U.S. history. Despite that, the overall inflation rate was just 6.8%. When now we have the same inflation rate at 6.8% in the end of 2021. That is definitely more than the central bank's target at 2%. So the inflation we have now is not for underestimation. That's why the federal government is now going to reduce the money creation sooner than expected. And tapering of the quantitative easing is going to increase the interest rates. This means that there will be reduction of the money coming into the financial markets. The money are going to slow down, and the prices of assets like stocks will not have the same growth as for the last 2 years. The inflation in the 1970s was stopped with increasing of the interest rates, which got at 1.20%. Nobody can imagine in modern days these kind of interest rates, so this is not an option. The inflation is not going to stop in the near future, even with the tapering of the monetary policy. It's not going to return to pre-pandemic levels anytime soon. Productivity rate, which is the real driver for better standard of living, will need a lot of time to catch up with the demand and the money supply in circulation. The more money supply in circulation is creating bigger demand than what is produced. The overpricing of assets like real estate is also driving the overall cost of living and inflation, as there is more demand, and banks are letting loans to everyone who is buying homes, because the price this way will always go up. In December 2019, the US dollars in circulation was 1.76 trillion. Where now we have a $2.2 trillion, which is increase of around a quarter, for an economy that is weaker than before. We have a lot more money and demand for less or the same things, and inevitably inflation had rise and is going to stay. But similar to this situations had already happened. In 1971, President Nixon removed the gold standard and started printing a lot of money. In 1933, President Roosevelt temporarily suspended the gold standard to the dollar. In 2008, similar to now, we have an all-time low interest rates. As interest rates are on an all-time low, it's a very good time to borrow money, as these low interest rates are not going to be here for long, because they will be increased to battle inflation.
Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So
staying profitable in inflation period is hard. Investing in times like these is very tricky, as businesses can struggle in the future because of higher wages and operation costs. That's why it's a good option to consider companies that can scale easily and have less expenses, like tech companies. They have very low cost of scaling, and the expenses are less than others that need big capital all the time. High return, low cost business.
you can argue that if you owned some business required very little capital investment and had real flexibility of price during an inflationary period, so that people would continue to give up a half an hour of their own work every month to buy your product, and you leveraged it, then you might even beat inflation to some extent.
Warren Buffett also suggests to cut more your expenses. Increase your own earning power. Like better paid job or to be the best at what you do. And take part in the stock market. Capitalize on where the money are going. On the other hand, Ray Dalio focus on diversification, as it's better to put your money in more than one place. In more than one currency and country. This is a very good option, as the dollar in the US is losing a lot of its value, compared to other places, where still have a big purchasing power. New upcoming markets are a very good option, as they are doing well in times like these. Diversification is key for every investor in times like these. Investing in new upcoming markets can lead to some very good long-term growth. The next thing that is happening now is the increasing price for precious metals like gold and silver. In the 1970s, the price of gold really skyrocketed. Gold in modern times will be even more valuable, as it is used in consumer goods like electronics. The price of silver also increased. All currency are depreciating compared to the price of gold and silver. And when the printing press is put on, the value of these metals is increasing. The same is happening now with the silver and other precious metals. Gold and silver are moving steadily in value in inflationary times, as they are in short of supply and have some practical use.